All right, so we're going to go over chapter 2. Let me get to my notes. Okay, so in chapter 2, we started talking about financial statements. Does anybody remember the financial statements? What they're called, any of the names? Remember one of them? Matthew, you should remember one. No? What about income statement? Does that sound familiar? So we'll see the income statement again. We're going to go through some problems and look at cost and bring that in, look at a financial statement, of income statement, which is income is what? Money coming in, right, from your sales. And you have costs and you have expenses. So if you're, in this class, we're going to focus on producing product or selling some kind of manufacturing goods. You're going to have costs that are associated with that. And the business has to determine how we're going to allocate those costs. Okay, so we have our sales coming in, and then we'll have our costs, which is buying the products. How much is it going to cost in labor to build that product out? So think about a car dealership. You don't just have a car, right? You have all these parts that you have to put together in assembly. So you're going to have different departments. People are going to be doing different functions, and you're going to have costs that are associated with each one of those little departments. That comes in, that reduces, right? That comes off the sale. You also have operating expenses. So on the income statement, you'll see a section that says operating expenses, and it's everything that, that you have to pay out that you need in order to operate that facility. You may have rent, you may have office staff that's keeping track. You can have an accounting department, marketing department, maybe HR department. So you have all these different departments inside the organization. So you'll have those expenses as well. So you'll have the cost that goes into manufacturing. You're also going to have those costs of operating expenses. And the bottom line, once you take your sales less those, is what? Your net income or your net loss. Hopefully you have net income. And so we're going to talk about some of that as we go through the chapters. So I just wanted to refresh what that was, an income statement. Okay, so it's all of our income and our expenses. And how do we know about these things? A lot of ways that we get this type of information into our system is through source documents. So if we are buying products, usually we have a purchase order that goes out and we have an invoice that comes in. It's a source document. It's a bill that we have to pay. We have electricity. It's a bill we have to pay. That's a source document. So we have all these documents and different departments and people doing different things to get that into the computer. Okay, so we have those are our transactions. And when we have our accounting equation, when we put that document in the system, do you remember the accounting equation? Do you remember what that is? You're right. Assets do equal something. So assets equal liabilities plus what? Equity. Good. So that's our accounting equation. So remember, it always has to stay in balance. So there's always two sides. So we'll walk through that a little bit too. Not as much as we did in principles, because we're going to be focusing more on like how to calculate what the cost would be. So there's going to be times in homework that you'll have to use those numbers to put into the income statement. So when we do, you'll remember journal entries, right? Okay, so when we put this information in, we're going to have to record the transaction in the system. In the classroom, we record it on paper. Then we have something called post-it. So in the system, when you put a journal entry in, usually there's a button to click post. I have an old antiquated system at my office, and it says execute, which is the strangest thing to me. I've never seen that in accounting. It's not really an accounting software. It's a real estate software that they're using and have conformed into accounting. So some of the terms are different, which is very strange. But usually when you're putting a journal entry in, you post it. So what happens in the system when you post it is those numbers go into those accounts. Once they're in those accounts, then the financials can pull those balances in and let you know where you are as a whole. Okay, so you have lots of different documents, lots of different source documents going into the computer, and it's processing everything and bringing them to the right accounts through those posting journals. All right, and then once they're done, we can push a button and say, okay, print me out my income statement. Print me out, that's one statement, print me out, do y'all remember our balance sheet? The balance sheet? So the balance sheet we talk about in the equation, assets equal liabilities plus owner's equity. On the balance sheet, so we just went over the income statement. And obviously that has our income and our expenses. Then we have our balance sheet. And the equation, assets equal liabilities plus owner's equity, that's what's on the balance sheet. Usually, you'll have a title at the top. And on this side, on the left, you'll have assets. Do you remember what assets are? Can you give me an example of an asset? Cash. So we have cash. We may have equipment. Anything that's going to be useful for me in the future, right? That's going to produce some sort of gain. If I have equipment, I'm going to be able to use that to produce my products. Then I can sell them. If I have cash, I can obviously buy things with that cash. It's bringing me some sort of gain in the future. So we have lots of assets. We have people that buy on account, which is called accounts receivable. That's somebody that's going to be paying me later. So that's beneficial to me in the future, right? So I have all my assets listed out on this side. I have a total. And then on this side, I'll have liability. So remember what liabilities are? No. Receive is like I'm receiving money. Okay, so that's an asset. So when you're a liability, think about it this way. A liability means I'm liable to pay in the future, or I owe somebody something. I'm liable to provide a service. I have to have some liability, have to put that on my books to show, okay, I have to spend this money in the future. I have to do this work in the future. So that's my liability. We call that accounts payable. Do y'all remember that word? Accounts payable? Okay, so payable means what? We have to pay something out in the future. So remember, accounts receivable means I'm receiving money in the future. So that's an asset. And then accounts payable means I'm paying out in the future. So that's my liability. I'm liable to pay. It could be unearned revenue, which means I've collected some money, but I haven't done anything for it yet. I have to do something. I'm either going to sell you a product that you paid for, or I'm going to provide a service that you've paid for. So maybe somebody gave me $1,000 to go do tax return over at their place, and I haven't done it yet. I have the money. That would be unearned. It's not, I don't have to record that as my income yet, because if I don't do it, I have to pay that back, right? I'm going to owe them that money. So I'll either owe them the money back or I owe a service, so that's a liability. I have to show what I owe in addition to my equity. So my equity could be stock that we have there. It's going to be our retained earnings. Retained earnings is just what we've earned over the years. It just compiles in that every year. Everything kind of gets dumped into there, what we've made. Okay, so we're not going to get into a whole lot of real detail, but we will maybe bring those financial statements in when we're doing the homework. So that's your balance sheet. And then another one is the statement of owners, the statement of retained earnings, where you calculate your retained earnings. We also have statement of cash flows. So cash flows is that. It's looking to see what monies are coming in, what monies are going out. Okay, so if I spent the money, it's going to be on there. If money comes in, it's going to be on there. And we like to put that into 3 categories. So when we have the cash going out, did I use it for financing? Did I use it for operating, or as an investment? So we like to break those out and look at them. So those are the 4 statements we have. And okay, so we went over some source documents. We talked about when you get a bill, you have to put that into the system. When you have a sale of a product, you have to record that sale in the system. Who are you selling it to? Is it something that you're collecting cash for now? Or is it accounts receivable that's something you're gonna be collecting in the future? We have payroll. Everybody likes to get paid, right? So we want a payroll department, and the payroll department has to take all of the employees. Are they salary? Are they hourly? They have to put all that information in the system. So you have some sort of documents or timesheets that you use to put that in the system. We have bank statements. So we have to reconcile what the bank has versus what we have on the books. We want to make sure that what we have recorded on the books is correct and everything's there. We want to make sure there's something on the bank statement that's not on the books. Was it supposed to be there? Is an error on the bank side? Make sure we have everything correct, and then we balance that to make sure everything's correct. All right, so we know we have asset accounts, we have liability accounts, and we have equity accounts, which includes our revenue and expenses, because that rolls into the retained earnings. So there's going to be increases and decreases. Okay, so maybe I'm buying equipment. If I buy equipment, I'm using my cash to buy. So my cash is going out the door, which means my assets decreasing. But I'm also gaining another asset because I'm getting the equipment. So then that means it goes up. So up and down can be in the same type of account. Okay, or it could be that I'm buying something, some equipment, not using my cash. I'm going to buy it and I'm going to do a loan and I'm going to pay it back later. So that would be a liability. Okay, so now I have a liability that increases and I have an asset that increases. So now I'm still in balance. So we have that two side. All right, some of the terms are general ledger. Do y'all remember that term? What a general ledger is? So a general ledger is just a collection of all the accounts that you have. Most of the time in business, when you receive information, you're going to have an account number and a description. So let me give you an example. So I work in real estate, right? My boss, he owns Lakeside Mall. So our office is there. And we have some of the employees that work for the mall in the office there with us. So the marketing girl, she has her budget, right? She needs to figure out what am I going to be spending the money on for the next upcoming year. And she needs to be able to tell me what account number it's going into. So I'll send her a report, and the report will have the account number with the description. And she will use those to help her when she's trying to plug in what she's going to be spending for the year. She puts it in by month. So you may not be in accounting, but you have to know, okay, most of the time it's going to be with an account number and a description. I'm getting some reports from accounting and I'm working over here in marketing. So she's familiar with all of the advertising type stuff, all the different accounts that we have for that. Okay, so the general ledger has all my accounts. And then I have something that I can run that will also give me my balances. Okay, so if I want a general ledger detail, it's not only the list or the chart of the accounts, it's also going to give me the balances that are in each one of those accounts. So when I run that, I can get a detail that shows me, okay, let's say cash. So here's my cash account, 1,000 cash operating account. And I said that I want it for January. So all of January, I'll get all the detail. It'll show me all the ins and outs of cash on the report. I can run it for all my accounts. I can run it for the whole year. So there's lots of different reports you can get that show you what have you spent. So let me go back to my example with the marketing girl. So the marketing girl, she does her little budget. She's putting all her numbers in. And then at the end of the year, sometimes she likes to see, you know, how much money does she have left? Does she go over? And we can run those accounts for her to show her, okay, this is what we budgeted in this account. This is what's been spent. This is where your cash is. This is how much you have left. So we'll look at some of that in order to help her know if she's got more money that she can spend. So that's all that is. So the general ledger is just your listing of your accounts, and you can run trial balances, you can run details, and that'll give you those totals in each one of those accounts. We talked a little bit about the double entry. Remember, there's two sides. Okay, so if if I'm doing an entry, there's always going to be two sides to it on the journal entry. And we'll have some of that. It won't be as much journal entry. It's going to be a lot of calculations, but just want to refresh. Okay. So we have something called a T account. I don't know if y'all use T accounts in y'all's class. I like to use T accounts. It helps when you're looking at trying to figure out what happened in one of the accounts. So this is kind of a little example here. So I have three different accounts. I have cash, I have supplies, I have accounts payable. And you can see I have different activities that have happened. So right here I say cash is a credit for $100. On asset side, that means I have cash going out. Okay. On the supply side, I have a debit. And the reason why is because I have supplies coming in. They're both assets. Supplies I'm going to be able to use. They'll be beneficial for me in the future. And the cash is going out. So that's also an asset. So I have a credit and a debit. It's in balance. And the little T account can help kind of keep track of what's happening in those different transactions. And it's a way to come up with a balance. I find that it can be useful when you're trying to figure out what is the account in an account, like the balance in the account. It can be useful. Okay, so the trial balance I mentioned, the trial balance will give you a list of the chart of accounts. On the first column, it'll have debits, and on the second column, it'll have credits. And it'll just list them out. So this kind of shows you a little bit about an entry for a journal entry, and then I have a trial balance right underneath it. So right here with the trial balance, you see how it's just telling me, here's your accounts, here's your debits, here's your credits. They should equal. Okay. And then here's the format for a journal entry. So we have the date on there. When we put the debit in, the debit's going to be the first entry where we have cash, 30,000 debit. And then when we put the credit, the next account, we want to indent it in slightly. So that's your common stock and it's a credit for 30,000. So that's the proper format. Put the debit first. And then when you do your credit, make sure it's indented a little bit when you give the description. We probably won't use account numbers. If ever I'm doing a journal entry on a test, I'm just going to be looking for the account name, just so that I know that you know what account it is. Okay, this gives you an example of income statement. So you see how the revenues are first, shows your services, then you have your expenses. This is a real simple format. So remember, this is just the basics. This class is going to go into a little more detail because you're going to have product, and so you'll have cost in there as well. So you'll have revenues and you'll have the cost, the gross profit, and then you'll have your expenses. At the bottom will be your net income. So that's an example income statement. And then we talked about the statement of retained earnings. So this is how you calculate that. You have your beginning balance, add in your net income, and then you want to deduct out any dividends, and that gives you your ending retained earnings. So remember, if you have a corporation and you have stockholders, they're looking to invest in you so they can get some money back, right? So when you have a corporation that has stock, you are going to take some of the profits and you're going to pay that out to your stockholders. You don't have to be a publicly held company in order to be a corporation. Sometimes it's just the family members or the stock members. Like if there's, a family that owns the organization, okay? They can do a corporation, they own stock in it, and then they'll distribute through dividends some of that income to the family. Okay, so again, retained earnings is a collection of what you've done in the past. So this current year, they have $330 that they have in as income for that year, right? So that's the ending balance. When they take the net income and you pay out the dividends, that's what they have left. So that number will roll into next year. And then you'll do the same exact thing. The only difference is this time you'll have the beginning balance of $330. Add in whatever you made. If you paid money out, you'll deduct it. And then at the end, you'll have your balance. So hopefully it's accumulating each year and getting bigger, that number. Okay, and here's an example of the balance sheet. We talked about that. The balance sheet is assets equal liabilities plus equity. And that's how we have it laid out on this example. Assets on the left and liabilities and equity on the right, and they should total equal the same. Okay, so in order to calculate your statement of retained earnings, you have to know what your income is. So the first statement we usually start with is that income statement. And then we'll go into the retained earnings because we need the net income to roll into that. Then you'll do the balance sheet because you need your ending retained earnings to roll into your equity section. So there's a process of how it works. Okay. All right, we're not going to do the debt ratio. So do y'all have any questions about the overall review? No? So all the questions on the homework are going to be going to help refresh what type of accounts are assets, what type of accounts are liabilities, are they increasing or decreasing in certain transactions. So I don't think the homework will be too hard. And like I said, on Moodle, I have all of the notes. So this is just some bullet points of things that I wanted to talk about to help walk through explaining. But when you go into Moodle and you look at the notes, you'll have the detailed notes like this. So they'll have some more information there that just kind of bullet points. So you don't have the book to read, but you do have these notes. And I think that this should be good. But if you get stuck or have questions, obviously just go ahead and email me and I'll help go over that. We're not going to go into the ratio. I think it's at the end of the chapter. Let's see, the debt ratio. I think that's, so right here, this last part, you don't have to read through that. But this explains what we just went over with the trial balance, with the chart of accounts, source documents. It'll have a lot of that information in here that you can read through. And so that first chapter of homework is going to come from the chapter 2 information. So these notes can help. Also, there's the PowerPoint that's posted on Moodle, which, let me see. I put chapter 1 on there as well if you feel you need it. It's got some more information in there that could be helpful. If you really feel like you need to go back and read through some of those first things, the terms and stuff, the different types of organizations, that should all be in chapter 1. So here's the PowerPoint. You'll have, access to the slide as well as the notes down here. So you won't have the narrated PowerPoint like you do for the book, but you do have all the notes at the bottom that you can read through if you're stuck on understanding a concept. Okay, and I don't want this part of the class to be too stressful. I just want to be able to overview, just kind of refresh what accounting is, how it works, how you get it on the books, try to help lay a little bit of a foundation before we get started, just jumping into doing product calculations and why we're costing this. So I want to get you to understand the foundation of how things are kind of flowing right into these documents. How are we going to be using them in business?